Well, good evening, everybody. Welcome to your session for this evening. Fantastic to welcome you to this first in what will be many webinar education series with me, Mike Smith. And the guys have asked me to come and join with them to give you some insights, some knowledge, share some experiences, and of course, listen to what you have to say as well. There's a few people on here I know already. Good to see you here, guys. And of course, for those of you who don't know me, now part of the magnetic team as well, and I've been trading for around about 20 years, and I've been in education for around about 12 of those. So delighted to see you all here, and of course it's your session, not mine, so please feel free to ask questions, make comments, tell me how you're doing, and we will make it as interactive as you want it to be. And if you can, first of all, just let me know that you're hearing me and seeing me okay. Just type into the questions box. That will be fantastic. Thanks, Leslie. Really appreciate it. Hi, Joe. Cheers. Thank you. Cheers, Johnny. Awesome. Trevor. Thanks, Stephen. And Luke and Scott. Thank you very much. Right. I've got to put up this important message, first of all, of course. Obviously, any information that we share from magnetic trading to you guys is for educational purposes only. And what that means in practical terms is you do your own due diligence on anything that you see or hear. And of course, make sure you follow your trading plans and manage risk on every trade. Any questions about that, of course, you can connect with us and we'll explain anything that needs to be explained. Now, what I am talking about tonight is probably one of the most common psychological issues that many traders face, even as early as a beginner, but certainly as you develop through your trading career, it becomes an issue for most, and we have to know it exists and of course do something about it when it does. So this fear of missing out, or FOMO, is a real key issue for many traders, and that's why of the many areas of psychology that I've looked at, it's one of the reasons why we sat down and talked about, well, what would be really relevant for the guys right now. Of course, we're going to be reliant on you in the coming weeks and months to give us a little bit of a hand in terms of what you want us to talk about on these sessions, and you'll get some communication about that as we go. Well, I hear your question regarding LTG Gold Rock. Can we tackle it outside here? If you just ping support and ask them to forward your details on to me, I will explain all and tell you what's in its place. I was expecting a couple of questions about that. Okay, well, look, it always makes sense to go back to the beginning in terms of what we're actually trying to achieve here and how trading results occur. So, of course, we all see the same markets. We might look at them at different times, and of course, we look at them in different ways, and different time frames and different instruments. But essentially, we're all faced with the same stimulus or the same market action. And ultimately, we have a response to that. First of all, we've got to do some interpretation about what we think is going on. Then we've got to apply some systems that we've developed, i.e. a trading plan, and obviously some measuring systems, which I know you've discussed before, but we'll no doubt come back and discuss again. And then we've got to make some decisions and take some action. And ultimately, of course, it's this that creates the results. Now, the great news about this is what this model means is that everything that happens is in your control. You're in control of the learning that enables you to interpret markets. You're in control of putting the work in to develop and apply the systems. And of course, you're in control of making the decisions. So irrespective of what the market does, your success or otherwise in trading is really bottom line up to you. Our job, of course, is to help you along the way and help you with the development in these three areas. And of course, one of those areas is right at the end, right before we press the button. And we term what happens at this stage often the impact of a cognitive bias. Now, before we go on to FOMO, FOMO is a bias. So I'm going to explain what biases are to start with. And then we'll go on to describe this particular bias, and then we'll go on to what it looks like in terms of symptoms, what you may be doing, and of course, ultimately, practical ABC in terms of how to actually manage it. I hope that sort of model makes sense, but it's right at the point of action that these biases will impact our behavior. So you'll see there's a rather complicated sentence. These are potentially damaging automatic heuristics that kick in at the time of actions. Now just for clarity, when the psychology world talks about heuristics, they're talking about sort of automatic ways of behaving that usually are learned and usually are set in place. And in some situations, they're useful. So for example, you're driving down the street, there's someone crosses the road in front of you and you slam on the brakes without even thinking about it. So you've an automatic, your brain doesn't think, oh my God, there's somebody on the side of the street, they're about to walk out. Oh, they're walking out, let's hit the brakes, let's press the brakes. So heuristics enable us to take shortcuts in terms of not having to think about every little detail. Heuristics are used a lot in medicine in terms of determining what's wrong with somebody very quickly. So in some situations, heuristics are really useful, but these biases are damaging heuristics. And the bottom line is that regardless of how knowledgeable we are as traders, whether you're an inexperienced or an experienced trader, people often make decisions that are colored by existing behavioral biases. And this means in practical terms that we actually move away from doing what we originally intended to do. If we look at what a lot of the evidence that I'm using for this comes from a field of study called behavioral finance. So there's actually a field of science which looks at investment and behavior and the psychology of the two. So these aren't just something I pulled out of thin air. Now, what happens is we all have these behavioral biases in place to some degree in many cases. Now, in a trading context, because trading is quite a complex and intense situation sometimes, as we get pulled into what's happening in the market, then any biases that may be in place already may be exaggerated and cause us to act in a particular way. And at least they can limit potential. So we may find our results aren't possibly what they should have been if we'd actually followed our plan to the letter. But at worst, can severely threaten performance and subsequently trading outcomes, because if we're doing not quite the right thing every time, even though the impact on one trade may not be significant, over a number of trades that can add up. And we're going to look at our trading account, think, oh my God, this isn't working. I'm not a good trader. So confidence suffers. It makes it even more difficult to be disciplined if our confidence is not where it should be. And of course, ultimately we can adopt the major sanction of removing ourselves from the market already, which is really the sad thing about it all is, and I've seen this time and time again over the years when I've worked with people like you, in that they've really been battered for so long with not getting the results that they'd hoped for, and often with just a mismatch of a small detail of their trading plan, that ultimately they just think, nah, that's enough for me. And so not only have they lost some capital, but they've lost the potential to be the trader that they can become and do this for a lifetime, because that's, of course, my guess is that that's where you all are in terms of what you wanted to do with your trading. You don't want to do it in the next month or the next year. You want to do it for a lifetime, as we all do. So these biases are almost automatic things that kick in just as we're about to place a trade. So almost subconscious in terms of their thinking. So for example, let me just give you an example of that. So let's say you've had a series of losses. You enter a trade according to your plan, and then subsequently it starts to go against you a little bit, not a lot, but just a little bit at this stage, nowhere near your stop. But what you But what you feel subconsciously is, oh no, here we go again, and you'll press the button just to get out of it, only to see it sort of move higher. So there's an example of a bias, and that's really how it all occurs. So what we need to do is we need to regain what happens at the time of trading action, and with all of this stuff, with all of the psychology stuff that you'll hear me talk about, not just today, but perhaps sometime in the future, if we look at other psychological aspects, then the critical first step is developing an awareness. And this is not an awareness that, hang on a minute, is that me? And that's one of the things I'm going to ask you to do when I talk about what actually happens practically in trading, but also the degree to which this is the place. So is it something you do all the time? Is it something you do in particular market situations or circumstances? Or is it just something that pops up every now and then when you're not on your guard and haven't put yourself in the right state to start to trade? So if we know what these are, then of course we can become aware that they exist and may be an issue for us. And then of course we have the goal subsequently to put the things in place to correct any mismatch between what is happening and what you should be doing. And in this case, of course, it's not following your plan versus actually following your plan on entry and exit. And additionally, it's important to differentiate this from things that we do when we're developing as a trader, so trying out new things and that may be not part of our plan for right now, but we're putting in a process that sort of says, I'm going to try something different. So, but we all know that when we do that, then we need to sort of, we need to test out first before we trade it. So, but it is a different thing to that. So what do we mean by FOMO? Well, fear of missing out appeared to start in sort of early 2000s. And interestingly, it was used to describe a phenomenon appearing on social networking in that, you know, this, you know what happens. So you pop onto Facebook and you see what all your mates are doing and other members of your family, and everybody posts some great stuff up there. Oh, I'm doing this, I'm doing this. Oh, what have I achieved? I've achieved this marvelous thing and that marvelous thing. And it was found that some people were entering a negative emotional state because they were looking at what other people did and judging themselves on a basis of that, and sort of saying, well, look, I'm not doing very well. I've not got those experiences or got those rewards. So what they would do is they would perhaps alter their behavior to sort of pretend they're doing this, and simply because they wanted to appear as though they weren't missing out compared to everybody else. So that's where FOMO appeared from. And then the concept was taken and it was put into other concepts. Oh, sorry, other contexts. And these negative emotional states could be quite dramatic in terms of reduced feeling of competency, tension, lack of control, low self-esteem or self-efficacy, and of course, altered behavior from what they should be doing. So these similar situations right across the business world, people are looking at FOMO, and of course, we can look at it in a trading context, and now is part of the general trading psychology or behavioral finance umbrella of things that traders can suffer from. And in this context, it's really the anxiety created by missing out on what is possible. You know already, I'm sure, even from a very early stage, that there is trades that you've entered and then subsequently exited, only to see them continue to go higher, and you think, oh, that could have been me. In the case of FOMO, we see that and we start to take action on this fear of missing out on a potential upmove, because of course we're driven to a large degree as people by this greed. So there's a strong argument for saying it's not fear and greed, it's that dictates many uncontrolled traders' actions, but rather it's fear of losing and fear of missing out. So the similarities are there in it. So what was happening is because you're scared of missing out on something, you alter your planned behavior, what's written in your trading plan. And of course, that's usually done without testing. It's just done on the emotional response to what you're seeing for right now compared to your current position, so or potential position. Does that make sense, guys? Let me maybe give you an example. If I sort of look, let's maybe look at the Nasdaq 30. Okay, so here's a really good example. So there's a really nice breakout trade when the Fed did the thing last night, and Jerome Powell came out and said, "It's all okay, guys. Yeah, we'll get a small bump in economic growth, but we'll control inflation and we'll all be okay." And that's why the markets did this. And of course, he delivered the 0.5 as was expected. It wasn't worse than expected. If we put this on a 4-hourly chart, you can see on a 4-hourly chart this point here at 13,556 is a point of resistance. And so that's quite clear. We know that already. So if we're trading the 30-minute chart, usually, and we'll talk about this at a future session, usually if we see a line of resistance, we won't put our take profit on the actual resistance itself, but a little below that, because we know that often it doesn't quite get there. So let's maybe use half an ATR, and let's say we're going to put it 24 points below. 24 points below the level here. So we'll be at 13,556 minus 24 is 13, about 13,229, which is about here. Okay, so there's our initial profit target, right? Would possibly enter on this candle here, and we would possibly place a stop somewhere around this point here. Okay, so there's our stop, there's our take profit, and there's our entry. So this is what would happen with someone who's FOMO, who's got FOMO as an issue for them. Or what might happen is they see this and they think, whoa, look at this is good, look at how good this is, look at how good this is. Oh, it's getting me my take profit. What I'll tell you what we'll do is we'll forget that, because it's going to keep going up. We're actually going to put it up here. So we're going to move, what they would do is move this take profit higher in the hope of grabbing another 50 points. And there is a reason, of course, this is called resistance, and there is a reason, of course, why we're putting our take profit here. But what happens is they think, oh, but what if it goes up? What if it goes up from here? And ultimately, of course, it never goes up to there. And so what happens now, particularly if they haven't got a trail stop, which is possibly another topic for another session, is now not only have they not banked that for the hope of another 50 pips, but they've not banked that, not hit the profit target, and it's now down around about 120 points from where they would have got out originally. That's FOMO in action. Does that make sense? So one of the symptoms of FOMO is to take your take profit and move it higher in the hope of grabbing some more dollars. Does that resonate with anybody? Okay, we've got a couple there who are saying yes, that's me. We've done that before. And as I said before, it's not necessarily something that you would do all of the time, but it may be that you get very excited by the velocity. So it might be in a high velocity move like this that happens. So it was fortunate that I had a look at the Nasdaq an hour ago and said, oh, it's not interesting. I'll use that as an example. So, but that's one of the 3 common symptoms of someone who has to battle FOMO. And bear in mind, of course, that these aren't, that there's nothing wrong with this. This doesn't mean there's anything wrong with you if any of these things are the case. It's a fantastically positive thing that if you recognize, that's me, and of course be honest about the fact that it's you, and then, and only then, can you do something about it. If you ignore that it's happening, if you don't measure what you're trading, if you don't measure your trading, to let you know that this is happening, how much you're leaving on the table because you don't do this, then you're never going to improve. So it's all fantastically positive if you identify that this may be you. Even if it's not, but it might sound a bit familiar, you can go and check it out and just make sure it's not you. And of course, if it is, do some stuff about it. So that's what we mean by FOMO. So what I'm going to do is just give you a broad overview of where we might see FOMO, both in entry and exit. So here's 4 common entry approaches. So a trend reversal, a breakout trade, a bounce, and a trend continuation. So again, for those of you less familiar, and of course, on top of that, we've got the amazing strategies that the guys teach based on market function, but you've had that before. Okay, so our approach is trying to get into the start of a new trend. If you don't, then it's questionable whether you should enter later or not. So let me give you an example of that again, because it's always good to put it on a chart and give it a bit of an example. Now, if I can't find an index trade, then so let me just we've already shown you a breakout. There would be a breakout on the S&P 500 30-minute chart. Okay, so it's been in a period of congestion and it breaks to the top or the bottom. So that's a breakout. Trend reversal. Let's just put it on a 4-hour chart, which is trend reversal would be fairly obviously when it comes down here and then sort of moves up. So we'd enter somewhere around there. Trend continuation would be, let's say we're short here. We had a trend pause and then we continue along that sort of line and look for an entry here. And then a bounce strategy would be, okay, let's say you see how it's trading within a range here. A bounce strategy would be to trade a bounce off the bottom of this range. So we might get in on this candle here and trade it up to this point here. So those are the 4 entry approaches and the 4 technical approaches. And I'm using those as not to say, oh, you should have all of these in your plan, because you've already got some plans in place. And you may use some of these as well. But what I'm doing here is trying to say, well, look, there is a point at which you enter and there is a point at which you exit. So we don't want to be entering here, or let's say on this trend continuation. So we get the move down, we get the retracement, and then we enter once it's broken that pivot low. We want to be in here when it does it. We don't want to be in it here when it's done. Okay, so if we miss the entry, should we actually be entering later? If we miss the entry on this trend reversal, should we actually, we're trading a 4-hourly chart, should we be entering later at this point when we see it? If we are trading a bounce, should we enter it here when it's halfway done, back up to the point at which it might come to? And so the reality is, with FOMO, the potential is that we enter after a signal is long gone, okay? Without, obviously, I've already referenced trend continuation. So if you've got a plan for trend continuation, let's say that those kind of criteria aren't met. And you know yourself, so if Mark and Cameron put out a trade that they're interested in trading, then really the optimum time for you to trade that is when it actually fits the criteria, not 50 points later or 100 points later. But if you don't get to the computer in time and you think, oh my God, I'm missing out, that fear of missing out, and so you enter it anyway, even though that trend is long gone in terms of where you should have got into it. Sound familiar? Okay. And if we look at our 4 key exit approaches, then we've got an initial stop, a trail stop, a profit target, and what I would term an event stop. Again, we'll do a session on this perhaps, but this is when personal circumstances may say it's time to get out. There's other things you need to focus on, or market risks have increased to a degree whereby you need to maybe adjust or maybe reduce the number of positions in your portfolio. Does that make sense? But whichever exit strategy you utilize, the optimum approach is to get out as soon as an exit signal is presented, or in other words, one of your defined exit criteria has been hit. Well, Scott, that's great. That's fantastic. Yeah, lots of yeses to some of these, and that's great because you're owning it, and that's, as I said, that's the first stage. So the danger with FOMO is remaining in a trade when your exit criteria are screaming, get out, in the hope the price will move further in your favor or back in your favor. So those are, if you like, broadly the two umbrella times at which FOMO can strike. So with any trading choice, good or not so good, there are actual and potential consequences. So what I mean by that, okay, so everything, if we look back on that original diagram, you have the choice to learn to interpret markets or not to. So you can make some assessment of risk and decide what's good and what's not good in terms of position sizing, how many positions you should have open, whether you should be trading at all. You have the choice as to, I don't know a textbook on the planet that says don't have a written trading plan. I don't think there's one in existence. I think they all say the same thing. But ultimately, it's quite bizarre that more than 60% of traders don't have a trading plan. Let me give you a really, and I remain staggered at this. It is you have a choice to or not to, and many people make the choice not to. We know that it's a good idea to measure your performance. And yet I was at a conference, right? And this was a conference full of really, really experienced traders. Like, they've been in the market for a while. Some fairly new ones, but most of them were pretty established. And I did a straw poll into that. I said, well, look, we're talking measuring trading performance. I said, well, look, how many of you keep any sort of journal in terms of what you're doing in terms of your decision making? And there was less than 10% of people put their hands up. Now, if you want a real trading edge, just as a side issue, if you want a real trading edge, you do what great traders should do. And what great traders do is they have a trading plan, they follow it, and then they measure the performance of that plan as well as themselves. That will put you in the top 10% of traders, period. Okay, so if you want to create a trading edge, there's your start point. If you don't do that, then there are consequences to making those choices of not having a trading plan or not following it or not measuring whether it's working for you or not. So in the same way that we've got choices to, in those broader concepts, we've got choices as to whether to address FOMO or not. If you see you're doing some of the things that we're talking about here, you've got a choice to do or not to do. But remember this, we've based our trading plan on at least logical reasons for the entry and exit criteria that we've used. Even at a basic level, even at an introductory level, when we're looking at, and it doesn't matter whether it's a technical trade or whether it's a market function trade, so let's say it's an end of quarter trade, there are set criteria that say this is the signal, or these are the signals that this is starting to happen, and the guys will let you know that that's happening as well. And of course, there are logical reasons for that. It's a readjustment of institutional investors at the end of a quarter, and so there's logical reasons why you're doing what you're doing. Yeah, we think we know better than the market, or we're scared of missing out. And we throw logic out of the way. And even worse, once you have moved beyond the beginner or advanced beginner trader, you move into the immediate level of trading, then what you should be doing is starting to gather evidence through this measurement that parts of your plan are working well and parts of your plan maybe need a tweak or two. So we do that. So we've not only had logical reasons for entry and exit, but then we've done some evidence gathering on how to make it fit for us as an individual. And yet, with FOMO, We move away from these completely with an emotional response that's based on nothing logical, nothing evidence-based, and without testing as to whether outcomes would be better. Because, of course, again, just for context, if we look at this, let's slam on a footsie and just see what that's doing as well for now, right now, shall we? Let's keep it right. Okay. Ooh, okay. A bit of a nice open, a little bit of a weaker continuation. Looks as though we're gonna pop back. Just put on a 4-hour chart. So it looks as though we could be, maybe be sort of a little reluctant to go with this 4,600. You can see that on the line chart pretty clearly. There was a support and resistance there. This resistance here, here, and here. Looks as though it could be honoured. And of course, 7,600 is a nice round number, and we know how the market likes those. But we could get very excited, and we could say, well, look, we're seeing this bar here. We could get into this. We could, even though there's not a close over that, we'll get into it anyway, just in case. Does that make sense? So if our plan says we don't get into a trade, and it doesn't matter which time frame, if we look on the hourly chart, if we look on the 30-minute chart, we'll see exactly the same picture. It's called resistance for a reason. The candle has closed below this level. Therefore, unless we're trading this away, we're not going to get into this. We're certainly not going to get into this long, because most trading plans will say if it's if we're trading technically, we'll say above a resistance, it's going to be a close over that level. So irrespective of time frame. Make sense? Good. So if we have that in our plan, then any move outside of that is usually an emotional response, because we get very excited because we saw this in the first minute or first 2 minutes. We're like, oh, look at that move. We don't want to miss out on this, even though we're actually trading a 30-minute chart or even a 15-minute chart. We see it on the 1-minute or 5-minute chart. Even though that's not part of our plan to trade those timeframes, we get into it anyway because we're wanting to not miss out. And that's a purely emotional response based on that price action, not according to a plan that says we're going to wait for a close over the resistance level before we get in. Now, it might be that maybe we say, well, hey, hang on a minute, we're maybe missing out on some trades by not trading this 1-minute bar or these 5-minute bars. Or we're going to trade in the opposite direction to this first move, which of course is one of the things that we can do. So we would say, oh well, let's see how high the bar goes, and then trade it down back to this level here, take profit here, boom. There's a nice little trade, a nice little trading idea we can test and then forward test and then subsequently trade perhaps. Now, I'm not suggesting you do, but that's one way we can look at it. But we don't just go and trade it anyway. So if you see something that might be happening on a couple of occasions, because often this is why people sort of embrace the FOMO, for want of a better term, is that we see it happen a couple of times where we actually do miss out and think, oh, I don't want to miss out anymore. Let's do it. So we want to avoid these emotional responses because we've got a plan which is based on something logical, which is based on something with evidence. And if we see something else, another price action that looks worth trading, then there's a process for actually testing that out and making sure that it's okay, including the specific entry and exit criteria before you go and trade it and slap your money on it. Anything else is FOMO. So file it to the side and say, I'm going to find a way of trading that. No, I'm going to trade it anyway. So what I've done here is I've tried to describe the 3 key areas where FOMO is the case, where FOMO can raise its head. So these, if you like, are your symptoms. Okay, so we'll start with the first one here. So our trading idea, our planned action, is, as we've suggested, to enter a trade as soon as possible after a signal is presented. Okay, so we get something coming through on the app, we see something that fits our plan, and we think, right, okay, that's good to go. And we want to get in as early as we can, providing it meets all of our criteria, and we're not. There's actually another one I'm going to add in here. But what actually happens in this case is we see an opportunity that presents a series of candles ago. So it was an opportunity an hour and a half ago, but maybe it was an hour and a half ago, not now. Now, the correct action, and this is what we should be doing if we're following our plan, is to leave it, file it, it's gone, we look for the next opportunity. Or we wait for a potential trend pause. If we've got a trend pause plan, which looks like this, comes back down, breaks that pivot high, and we can then subsequently trade that, providing the RSI is not over 70, providing there's volume behind that, etc., whatever your plan says. So that is the correct action. However, when we have FOMO, we have this internal voice that says there's plenty more upside in this potential move. And so what actually happens in practice is we get a late entry on the trend. And the consequence is not only have we missed out on this initial opportunity because we've not looked at the market at the right time, but we also could be entering when a trade is almost complete in its movement. Neither of those scenarios, none of those consequences are going to be good for dollars, which are going to at best be lower than you could have got, but at worst, you've entered too late and the thing turns around and goes in the other direction. I'm going to do another entry, one that's here, which I just referenced before, which again is a FOMO thing. So the planned action on this, if we look at a chart, I'm just going to get rid of all these drawings, is exactly that we described here. So our trading plan says we're going to enter it as a close above a resistance line on our 15-minute chart. And yet what happens is there isn't. So we enter here, even though it's not the close. And of course, this happens subsequently. Why do we do this? We're scared of missing out on the up move. Because what if our close is here? And we've missed out on all of this. This is a sort of subconscious thinking that goes on. We're scared of missing out, so we're not prepared to be patient, to wait till the end of the candle. We've got that itchy trigger finger that says, boom, we're in. And of course, we're in, and then subsequently that happens. So if we were to use our sort of model, let's just get rid of that we're sort of working through here, the planned action would be to wait to enter a trade until the signal has presented. Correct action is to actually follow the plan and make sure all the ticks are in the boxes. Our formal dialogue is we want to get in now because we can be ahead of the market and we'll make a few more bucks if we get in now, because it's going to happen anyway. And ultimately, we see that potential itchy trigger finger trade not happening and we lose money accordingly. So that's, you've got a bonus one there that I don't usually include in a presentation like this. Number three, so those are two entries, two exits. To exit as soon as initial stop or trail stop is triggered. So we have stops in place for a reason. If you use trail stops, and I do, I know some traders don't. Some people have a move up to break even, and then so there's a stop, a break even, and or a stop or one move with potential half a closer position, and then there is the profit target. Other traders, what they'll do is they'll trail a stop as a trade moves in their direction. We'll talk about that in another session. So that's what I mean by a trail stop if you're less familiar. But the bottom line is, in either case, we've set a line in the sand that says, if it moves down to here, we're out of there. Okay. But what happens is the price will get close to trigger. And our correct action is, well, look, if it triggers, it triggers. But what we've got is all sorts of stuff going on from our FOMO internal dialogue. I think it's going to bounce off the current level and then continue in my direction. So what we do is we move our stop away. Let's just move it down. Let's just move it down and see what the next candle's doing. Let's just move it down, because I'm sure there's a key level there that it's going to bounce off. And of course, what happens is with moving an initial stop away, we've got the potential for increased losses, because of course we position size according to where our stop is and the amount we want to risk on a trade. If we move it away, then we're risking more on a trade than we originally intended, and therefore we're increasing our losses. Or in the case of moving a trail stop away, we can potentially give more back to the market. So let me just give you an example of that. So let's say the DAX and a breakout trade on this candle here. Okay, and we initially set our stop at this point here. Now, there's a couple of reasons why you wouldn't enter on this candle here, not least because it's low volume. But let's say we do, and let's say we like this setup, and let's say we think, all right, okay, well, let's put our stop at this point here. So what happens is we enter it here and we see it doing this, and we think, oh, come on, get up, come on. We know you're better than this. Okay, we'll talk to the market. Okay, we know you're better than this. You need to go up. So it was here. Okay, and then we sort of say, oh, look at this candle here. So what we're going to do is we're going to look at these wicks here. This says that there's some support here, so we're just going to move it down there a little bit, and then, oh, come on, it's getting close to it again. So let's say it's at this point here. So we'll look further back. Oh, look, that's a more established level. Let's use that. And so we move it down again. And all of a sudden, we've doubled our loss from which we originally intended. Oh, look at that. It's just gone through it in a heartbeat. Okay, this is it. I'm going to put a stop. I'm going to move my stop to here, and I'm going to hope it gets back to my former glory. At this stage, you're losing. Initially, your stop was around about, oh, it's at 130 points. With this now, your stop is around about 369 points down. So you've almost tripled your risk by doing that. Oh, it's going to bounce. Oh, it's going to bounce. That bargaining with yourself, bargaining with the market. And that is fear that it will do exactly what it did after you couldn't bear anymore, and you got out here, came down, tested this, and bounced off there. So not only have you lost your money there, but you've lost the opportunity to take a bounce strategy off this as well, because you're in such an emotionally destroyed state because you've lost 3 times as much as you were originally hoping to on the trade that was there. Okay, and that's an initial stop move. A trading stop move, let me give you an example of that. Find an example where we can use something simple. Okay, let's say we're trading a daily chart. Again, it's not, I wouldn't trade daily charts often, but there's a nice example here. So let's say we're trading a daily chart on the DAX. We're trading this breakout through this support here. So we're getting on this candle here. And what we're going to use is we're going to use a 10 EMA, a close above that as our trail. So I'll just bring that closer so you can see that a bit better. Corey's point is you look sometimes at the chart and you think, how did you get to this point? What did you do to actually create this? When you see that you've lost more than you intended, or when you see that your profit target that you moved away, it's now moving downwards. And I think you're absolutely right. It's mostly subconscious. You're not doing it deliberately. You are making a choice. You are even sometimes got some internal dialogue there. But in many cases, it's sort of happening and almost automatically, which is what these are all about. And often this scenario is only picked up when we actually go back and have a look at, well, why did we lose so much on that trade? And then we'll go back and have a look at the chart. We'll say, what was I thinking? What was I doing? But even by doing that, then what we're doing is we're creating that awareness, and that's as I said, that's the first stage for addressing that. Great share, Corey's. Anyway, back to this chart. Let's say we're using the 10 EMA as a trail stop. So have an initial stop here, and we get in on this candle here, and we say, right, okay, if it closes above the 10 EMA, which is this blue line here, then I'm going to get out. Okay, so ultimately by doing that, we get out here. All right. Now, but what happens is as it's come back up, you say, oh, look, it's gonna bounce off this level and come down again. So what I'm going to do is I'm going to use the 20 EMA. I'm just going to move it up a little bit. So I'm going to now use the 20 EMA as a trail stop rather than the 10 EMA as a trail stop. So what of course happens is it doesn't get taken out there, it gets taken out there, because it gets taken out anyway. It's just getting taken out at a worse place. How much of a worse place? It's about 495 points worse. It's not something you want to leave. Give back to the market, I'm sure. As I said, I'm not advocating trade daily charts, but some of you may go down that route eventually, but it was just an illustration because it was here and it was nice to see. So that's what I mean by moving a trail stop away. You've got something that's planned and you decide not to use it anymore, just in case it continues its way downwards and gets back to here. So we move to number 3, and that's to exit a trade where a profit target is triggered. So that's part of our plan. We set a profit target, whichever mechanism we use to set it. And even when the price is getting close to trigger, we say, if it's to trigger, we let it trigger. We're great that we can bank that profit. And then we can look for continuation criteria. But what our FOMO dialogue says, oh, but if it just gets up a bit higher, it's just going to go. It's just, and we don't want to miss out on all that potential profit. So what we do is we move the profit target higher, and there may be no little further upside, and the position drops back. So what I'm suggesting here is, if this is you and you have got a breakout as part of your strategy, there's a really easy way to manage this practically. Let's just choose another index. Let's have a look at the ASX and see what we could have traded on here. Okay. Right. So let's say we're looking at this hourly chart. We traded a bounce off this level here. Okay, so we got in on this point here. Okay, we've got in at this point here. We've got a profit target. You can see that there is a resistance around this level. So we're going to get out of there. Okay, so we're going to make this a real short, sharp 43-point trade. Actually, this isn't a good example at all. Oh, yes, it is. Okay, so, right. So we'll put it, there's our line in the sand, okay? So that's where our profit target is. Okay, so we see that, we enter here and we take our profit here, tick. Okay, but as it gets to here, we think, oh, it might go further up again. So we stay in the trade, stay in the trade, stay in the trade. And of course it did. And on this occasion, it didn't on the occasion where we looked at the NASDAQ before, which is still going down. So in this case, our profit target was here. And of course we took it. And in this case, so we do exactly the same on the ASX. If our profit target is here, we take it, knowing that if it breaks through this level, there's another leg up. Then there's another leg up to this point here at 7362. So another, what's that, 43 pips? 43 points, sorry. Okay, so we enter here on some criteria that we've got in our plan. We have a profit target here. We take it off. So in terms of this, we've got 43 there. And we've got, what's that? That's another 40, we say 43 there. Okay, so 2 different trades, but we've made 86 points there, okay? So that's point 1. Whereas if, and so with our NASDAQ, because we took our profit here, let's say we entered on this candle here about this point here, over that pivot high. So we've made 300, thank you very much, 334 points on this. Let's say it was just 300, okay? By having a profit target here, knowing that if it breaks this level here, it's the next leg up, it's the next breakout, so we can actually have a plan, a breakout plan that says, hey, look, we're going to get in here, and then away we go again, in the same way that we did on the FTSE we had a look at. Sorry, the ASX we had a look at. But what we've done here, so if we adhere to our plan, we would have 300 pips there, we'd have 86 pips from the other, so we'd have 386 total for our tick. Now, for our FOMO, okay, so we're going to use a cross for that. Then we still made 86 out of actually, we probably made a little more. Let's say 106 because we didn't have that little. If we look back at the ASX, where I've gone. If we look back at our ASX, we wouldn't have had that little gap because we got out here and got back in there. So let's say we made 100 pips, sorry, 100 points, yeah? Going back to our NASDAQ, so let's look at our scores on the doors. So we've got 100 points here from our ASX, and we haven't got 300 points anymore. Why? Because we've just given back, because we've got a bit greedy, because we've got a bit FOMO-y, and then we've given back 150 points. So we've now only got 150 points left from where we entered. So in this occasion, we have, so that's our ASX, that's our NASDAQ. Remember, it was 86 and 300. So you've got a choice, 386 points or 250 points. What are you going to choose, guys? Which one would you choose? No brainer, really, isn't it? But that's all to do with managing your FOMO. It's all to do with saying, I'm going to take profit. I'm going to take it, knowing that the next move is perfectly legitimate. Let's just get rid of all these drawings. We've got our next level sitting right there. So if we do break this, our plan says, because we look at the longer time frame to find the key levels, our plan says we can enter here because we're clear that this is a new trend. We're in congestion for this period here, and rather than breaking to the downside, we break to the upside. And what we've got is we can bank another 147 pips. Okay, that's another meal out paid for to take your mum out on Sunday. Okay, so is that hard? Is that concept rocket science? So we have a take profit for a reason. It's based on logic. It's based on evidence. What that means is we should take profit. Does that mean we're going to miss out? Well, no, not if we've got a plan to take advantage of the next move higher. That's the logic. But of course, we're driven by emotion when we're driven by FOMO. And FOMO says, let's move it up just in case. And we're quite happy to give back half our profit for that just in case in this particular situation. Thanks, Nick and Sue. Great feedback, Scott. Thank you. Okay, so I've given you 3 and a bonus 1, which is your itchy trigger finger. All of this, we need to have the correct action. We have a plan, we need to trade it religiously. It's only then we can see with certainty about whether our plan's working or not, about whether we need to tweak a little bit to make it work even harder, even better for us as individual traders. Why do we get FOMO? Well, look, so these are some of the causes. Use this as a checklist. Ask, is this me? So often an incomplete plan, if you've got statements which aren't specific. So it's no good saying I'm going to trade a breakthrough resistance because that doesn't say whether it's a close, whether there's anything else you're going to use. Is it what does through resistance mean? Does it mean 1 point? Does it mean 10 points? Often with a lot of the traders I coach, they will have a great entry strategy, but will completely make a dog's breakfast of exits. So that's the first reason. Second is lack of confidence in your existing plan based on your results. So you're not getting great trading results. So what you do is you think, oh, maybe it's just going to get a little better if I do this or this. But we can only develop confidence in our plan if we see evidence that it's working. We can only see evidence that it's working if we measure what we're doing. And of course, we've already said, we can only measure what we're doing if we're measuring something specific and unambiguous. Oh, sorry, that should have been, made a little bit of an error on that. That should have been ambiguous statements because we want unambiguous. It could be that it's just simply experience. The reality is that when you're first trading, you've got a trading plan you've written for the first time. You're not sure whether it's going to work or not. You've not done enough measurement to say, hey, yeah, this is good. You get 3 or 4 trades go against you, which is not unusual, in a row. And you say, hang on a minute, this plan doesn't work anymore. Let's lob it away. When actually that's quite standard. And there's another bias called recency bias. I was coaching somebody the other day who was a prime example of this. He'd been smashing it out of the ballpark for the last 10 months, absolutely done superbly well, even in the first months of this year, which were quite tricky for a lot of traders. But over the last 3 weeks, he'd actually sort of had a number of trades had gone against him. And so he was absolutely devastated, absolutely gutted, and completely questioning his ability as a trader and his plan and everything to do with his trading on the back of a few results this month. Ignoring completely the previous 9 months, he'd actually smashed it out the park. So that's a classic example of recency bias, where you're just paying attention to what's happened in the immediate past, not looking at the overall picture. And of course, when we talk about measurement and those key numbers you should know as a trader, all of those help with that sort of bias as well. Just a little side issue there. Sometimes I might do that. Sometimes I flick onto side issues when something pops into my head. Absence of any measurement. Measurement creates evidence. Evidence creates confidence. Confidence means that you're more likely to follow your plan. It's really that simple. And then as I referenced before, experience of seeing trades do what your internal FOMO tells you it might. So I knew I shouldn't have taken that profit target there. I knew I should have moved my stop down to that or waited one more candle. I knew I shouldn't have trailed my stop up then. And so what they do is they start to trade. All you need is a couple of those and you start to think, oh, here we go. I know better than the market. I can feel the market. Or some of the other stuff that people will say. You have everything within your power. Right at the beginning, we talked about the things you're in control of. Everything that creates your results is internal. Why relinquish that power through not having a complete plan, not gathering evidence through measurement, and ignoring the good results that you've had just because you've seen a couple of trades you could have made a few more bucks in? And there's another bias called promotional bias. I won't bang on about that, but this is something I've had to battle with. Certainly, I would say it took me about 6 years to first recognize this, and probably about another 2 years of the market slapping me about a bit to say, hey, look, you can't do that. Everybody has a promotional and a preventative disposition. Another story for another day. But it's very similar to some of the things that you'll see in FOMO in terms of symptoms. So what do you do? Well, the first thing that you do, of course, is consider those things we've discussed today those symptoms that we've talked about and identify what's real for you. As I said, it doesn't have to be something that you do on every trade. It can just be something when, you know, when you get a few trades go your way, you put on your cape and you wear your underpants on the outside and you become super trader, Mr. Invincible. It's really hard not to succumb to that, hey, hang on, I really got this, and start to maybe move away from your plan a bit. So it might not be all of the time, it just might be in those situations. So what you need to do is to go away and think, go away and look at your journaling, which I'm sure you're going to, the number of times I've referenced mentioning your trading, I'm sure you're going to make that choice in the not too distant future if we tell you how to do it. But what we need to do is we need to, first of all, own that we're doing it. And then secondly, investigate why it's happening, the circumstances where we're doing something about it. And it may not be all three, it may be just all four as I presented today. It may be just one of those that you're doing. But the critical thing is you do the work on yourself to find out what it is that you're doing. And then, of course, you can start to put some things in place. Now, I'll give you the prime example of what to put in place with your take profit phobia or FOMO. Quite often, it's enough to split off your trades and say, right, let's look at my trading results. Because I've kept a journal, it's easy to identify these times when I didn't follow my plan, where I moved my stop down, or where I moved my trail down, or where I entered late, or where I did raise my profit target. Because you'll know that because those are the sort of information you keep in a journal. So you can separate those out and you can say, right, what were my results when I did that versus what were my results when I followed my plan. There's very little that's more compelling to see a dollar figure that's massively or substantially larger than another dollar figure to make you make the right choices. So even look at the last 10 trades that you've done, and whether it's FOMO or just simply not following your plan because you have a lack of confidence or whatever it is, have a look at your last 10 trades. Split them out between those that you followed your plan on and those that you didn't. Maybe 20 trades. Those that you followed your plan on and those that you didn't. Compare the results of the two. That's often enough to say, hang on a minute, I'm doing it, I'm at risk of doing this again. I know the potential outcome because I've got the evidence to say, look, if I do this, chances are it's not going to go well. Chances are it's going to be 150 pips, it's not going to be 380 pips that I'm going to make. Or it's going to be 150 pips I lose rather than 150 pips I make, or points, or dollars, or whatever it is. So follow that process. So develop awareness, own the issue, own that it's you and don't blame it on the market or volatility or whatever else you care to blame it on. So own the fact that it's you, because if you do that, then you know it's you that can make the difference, and subsequently put those things in place that I've talked about today. Compare when you did versus when you didn't. Look at different ways of managing those particular market moves that you're getting a bit twitchy about. And then that'll put you in a massively good place going forward. Even it's the smallest details sometimes that make a massive difference. So, so yeah, that's possibly where I would say it's in. So I'm going to ask you a couple of polls to finish off. So I want you to participate in these. So I'm just going to launch this first poll. So are any of the following that we've talked about today an issue for you? Tick the box that's appropriate to you. If it's not, then don't tick one. It's really easy. Audience participation time. Thanks for participating, guys. That's awesome. I'm not going to share these results. These are you taking ownership of what's happening. I'll give you the broad outcomes. That's really interesting. Over half of you participating. That's sensational, guys. This is what active learning is all about. It's all about getting involved. It's all about some of your comments and questions throughout the session have been sensational. So thank you very much for that. not only makes it less lonely on the other side of this, on this side of the computer, but it also helps me help you. That's great. So really, all of those three appear to be fairly key issues. It's impacting on many people. At least half of the ones that are voting are identifying each category. That's great, guys. You've taken your first step to addressing this. You've got an awareness. In fact, your first two steps, you've got an awareness of what it's all about, and obviously now you're starting to own it. That's awesome. Now, obviously, this is as I said, it's the start of a series that we're going to put together. And we're really excited about it. We're going to be asking you, as we said, about what sort of topics you want me to cover, and so we can make sure that it's focused on your needs, not what we think you need. So always, it's really good if I get some feedback in terms of the session. If you knew perhaps some of the concepts that we've been discussing have been a little difficult perhaps, and that's okay, because it's all part of learning. As long as you grasp the basic concepts, then that's what it's all about. And if you're already addressing this or already in control, you're not FOMO'd, then it's take on board some of the other relationships and concepts that this has applicability to, because whatever psychology challenge you have, be that discipline, perhaps not being as disciplined as you should be, perhaps you've got one of the other biases such as loss aversion or recency bias, perhaps you're not believing in yourself as a trader yet. Anything, it's those three areas of process: awareness, ownership, and action are going to be the things that make a difference. Guys, thank you very much for that feedback. It's fantastic. I'm just going to check in on your questions just to make sure. Yeah, so absolutely, Adam. We're going to put the video somewhere for you to review, because we realize there's and particularly when it's me that's teaching, I bang an awful lot into the space. Well, absolutely, mate, and don't forget to drop support line, get them to forward it onto my non-magnetic address, and I'll sort you out with the LTG issue. Brenda, thank you very much. That's wonderful feedback. It is about losing. It's not only about we dress FOMO up in a fear of missing out of a win, but often it's feeling a little bit of a loss. Leslie, I love your feedback and I love your honesty. That's really interesting. We need to find you a new challenge. Okay, we can. I bet you we could spend half an hour together and find you 3 new challenges that are going to stop you doing what you're doing there and what you're describing there. You just need something new to get your teeth into. If you've mastered what the guys are teaching, and that's where you feel you are right now, let's take it to the next level, buddy. Let's actually sort of make it really rock for you. Can we get the invitation to the webinar sorted out? You do it so well, always go. Yes, Brett, obviously this is the first one we're just trying to find the right infrastructure to make sure that you're all informed, and also that you can access the recordings. Scott, you're so well. You're so welcome, and I'm glad the recency bias was something that was useful. Right, Northerners rule. On you, Glenn. Absolutely, Northerners rule. Leslie, you're welcome. Stephen, what a great way of putting it into a nutshell. Steve, I hope you don't mind me sharing this. What Stephen says: I understand the trade, I just have to control me. That just encapsulates what we've been talking about today in a sentence. That's sensational, guys. All right, well, look, I really appreciate your time today. I think you've been fantastic in terms of your participation in the polls, your questions, all that sort of stuff. At this stage, just if you want to connect with me, then I guess you use support@magnetictrading.com. Watch out for future sessions. We may even look to do a rolling registration as these sort of gather a bit of momentum, just to save you registering every time. But they're going to be every couple of weeks, so expect something on the next exciting topic, an installment of the webinar education sessions when we meet very soon. All right, guys, enjoy the rest of your evenings, trade safe, and we'll look forward to seeing you again very soon. John, you're so welcome, mate, and great to see you at this context as well. Bye-bye for now.